In this chapter, we are going to cover the statement of cash flows. Back in chapter 1, when we were learning about the financial statements, we learned that there were 4 main financial statements. And we've been working all semester with the income statement, statement of retained earnings, and balance sheet. And now in this chapter, we're going to learn the 4th one, the statement of cash flows. And the statement of cash flows is showing the cash receipts and the cash payments and the overall increase or decrease in cash during the period. So the 3rd line in the heading for the statement of cash flows will be for the year ended or the month ended. It'll be for a period of time. And so the statement of cash flows is going to be informative for managers as well as investors and creditors because it's showing the liquidity. It's showing if the company has the ability to pay its bills, to pay dividends, pay interest, shows if there's room for growth, and it can be used to evaluate the managers. Because managers have a balancing act, they have to monitor liquidity. They want to make sure that they will be able to pay their bills when they come due. But if they have an excess of cash, they don't want to just leave it sitting in the operating checking account. They want to be investing in short-term investments if they do have some excess cash. The statement of cash flows is going to be broken down into 3 sections. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The operating activities are the bulk of our cash transactions. It shows cash received and cash paid having to do with your ordinary business operations, right? So, buying supplies, buying inventory, the sales, receiving cash from selling inventory or collecting from customers, paying on their invoices. Those are all operating activities. Investing activities are showing cash received or cash paid as a result of long-term assets. Financing activities shows cash received or cash paid as a result of your long-term debt or your stockholders' equity. So we can really, we need to analyze our balance sheet in order to prepare our statement of cash flows. We'll see our operating cash flows come from your current assets and current liabilities. Investing cash flows come from long-term assets. Financing cash flows come from long-term debt and stockholders' equity. And so we're going to be coming down to our overall net cash flow from each of these activities, showing if cash increased or decreased due to each of these activities. If we add together the increase or decrease from the 3 activities, we'll get the overall increase in cash. And then we can add that to our beginning cash balance, and that'll tell us our ending cash balance. And so your statement of cash flows we're going to see is going to tie out to the balance sheet. The ending cash balance we get on the statement of cash flows needs to be the amount we are showing on our balance sheet for cash. So if you get to the ending balance for cash, you can feel pretty good that you did the statement of cash flows correctly. If you don't come out to the ending cash balance on your balance sheet, then you know you've got a mistake somewhere. The only thing is sometimes I do see students get the correct ending cash balance, but they list an investing activity as a financing activity or vice versa. So if you get the ending cash balance, you can feel pretty good that you're pretty close to correct, but as I said, there is possibility for a mix-up between the activities. So we're going to prepare the statement of cash flows in 5 steps, right? We're going to prepare the cash flows from operating activities, then investing activities, then financing activities. Then we show the overall increase or decrease in cash. And then the last thing is to show a schedule of non-cash investing and financing activities. So our starting point is the cash flow from operating activities. And there's 2 methods for calculating the operating activities, the direct method or the indirect method. So the direct method is where it shows all of your sources of operating cash. So where you're showing all the cash you received from customers. Then you show your uses of operating cash, all the cash that you paid as far as your operating activity. So cash paid to suppliers, pay for your operating expenses, to pay your employees. So you're really analyzing all of your debits and credits to cash. And so it's time consuming, costly to gather this data. And so it's not going to be used. I mean, certainly what we're doing here, we're going to be doing it by hand. And so it doesn't, it would take a lot to go through all of the debits and credits to cash. A computerized system can do it more easily, but if you go and look at various annual reports for corporations, you're going to see the statement of cash flows is going to mostly be using the second method that we're going to be actually using in this class, the indirect method. And so the indirect method uses net income as a starting point. So if we look at our income statement, this is what we're saying with the indirect method. This is our starting point. We're saying net income is our rough estimate of our overall change in cash from operating activities, right? Because we're saying sales revenue is where we received cash, cost of goods sold, operating expenses, that's where we paid cash, right? So that's our overall change in cash is what we're saying. That's our loose estimate. So we're using that as a starting point. But we know that there are some things included in net income that don't involve cash. So we're going to adjust for those things that are included there that don't involve cash or that they're going to be reported elsewhere on the statement of cash flows. So the very first thing we have to adjust is depreciation. Okay, and so we learned early on, back when we were learning about the accounting cycle, we learned that depreciation expense is the way the company allocates the cost of a fixed asset to the accounting periods where the asset is being used to generate revenue for the business. And so when we're talking about a fixed asset, the cash outflow occurs when you buy the asset. So depreciation does not reflect a decrease in cash. It's a non-cash expense. And so if you think about it, it was shown as a subtraction, right? It was subtracted here as operating expense, so it made net income lower, but that doesn't make cash lower. Okay? So we need to add back depreciation when we are trying to convert net income to the net cash flow from operating activities. The next thing we have to do is we have to look at the gain or the loss on a sale of a fixed asset. So we are going to be reporting the proceeds from the sale of a fixed asset under the investing activities, right? The investing activities where we show the cash received or cash paid having to do with long-term assets. And let's think about the gain or the loss. So the gain or the loss on the sale of a fixed asset is determined by comparing the sales proceeds and the book value of the asset. So if we had equipment that cost $10,000 and we had accumulated depreciation of $6,000 and then we sold it for $8,000, okay, the book value would be $4,000, and if we sold it for $8,000, we sold it for $4,000 more than its book value, we'd have a $4,000 gain. So that $4,000 gain is going to be reported under other revenues and expenses. It's going to make net income higher. However, we are going to report that whole $8,000 proceeds when we come to our cash flow from investing activities because we received $8,000. So we don't want net income to be $4,000 higher because of this gain from the sale of equipment. So we need to subtract the gain on the sale of equipment. Okay? Because we don't want to be counting those sales proceeds twice. We're going to report the whole $8,000 that we received under cash flows from investing activities. Since a loss was a decrease on the income statement, we subtracted it as an other expense. We need to add it back, okay? Because we're going to handle the sale of the fixed asset when we get to the investing activities section. So after we have added back the depreciation, and if there was a gain or a loss on the sale of a fixed asset, companies don't sell fixed assets in every period. So you might have a statement of cash flows where you don't have any sale, gain or losses from a sale. Then the next thing we're going to do is we're going to analyze the current assets and current liabilities. And we're going to see if the current asset decreased during the year, we're going to add back the decrease. If it increased during the year, we're going to subtract. And so the reason why we're analyzing the current assets and current liabilities is because we need to back out the effects of accrual accounting. Okay? Because if you remember, right, when did we record revenue under accrual accounting? We recorded it when it was earned, not when it was received. So let's look at accounts receivable. Okay, we learned accounts receivable is the amounts that haven't billed. Oh, let me back up. The reason why we're looking at accounts receivable is because if we go to current assets, the very first current asset we see is cash. We are not going to be analyzing the change in cash because this entire statement is working its way down to the increase or decrease in cash. So cash is the only current asset that we will not analyze. We will start with accounts receivable. Okay, so accounts receivable we know are the amounts that we have billed clients. It's the amounts that our customers owe us for goods or services that we have provided. So we have recorded the revenue, but we have not gotten the cash for our accounts receivable. So if accounts receivable goes up, okay, that means our revenue went up. So that means we're including that amount in our sales revenue. So we're including an amount up here in sales revenue that we haven't received yet because the customer owes it. They're going to pay it to us later. So if that sales revenue is included in net income, and that was what our rough starting point was. So included in this number is the accounts receivable that we have not collected in cash yet. So that means we need to subtract that increase in accounts receivable from our net income as our adjustment on our statement of cash flows. So let's think about what does it mean if accounts receivable decreases. That means that customers are paying their bills. So that means cash is increasing. So we'll add that decrease to net income. If merchandise inventory increases, that means that we're buying merchandise. We're buying more merchandise than we sold. So that means cash is decreasing. So that's why we will subtract the increase in merchandise inventory. If merchandise inventory is decreasing, that means we sold more than we bought. That means cash is increasing. So that's why we'll add the decrease in merchandise inventory. And we can apply this reasoning to all of our current assets, except for cash. And so that's why if we have an increase to a current asset, we're going to subtract it. If we have a decrease to a current asset, we're going to add it.